Welcome to Bill's Market Insights. Today is April 26, 2026. We are analyzing a week defined by high geopolitical uncertainty and a fundamental breakdown in traditional market logic. As diplomatic efforts in Islamabad face a postponement, investors must move beyond linear thinking to survive a new era of non-linear volatility. To understand this shift, we must first look at the week's core catalyst, the failed attempt at maximum pressure via a total naval blockade. Designed as a classic economic lever to force negotiations before the April 21st deadline, the move backfired. Instead of a cost-benefit analysis, the response was a unilateral severance of communication and a characterization of the blockade as an act of war. For the markets, the diplomatic buffer zone vanished instantly. While an indefinite ceasefire was announced to hedge the deadlock, the market has correctly identified this as the failure of a high-risk marginal probe. Global risk assets plummeted as the linear logic of policymakers collided with the non-linear reality of sovereign conflict. This brings us to the broader strategic implications. We are witnessing a paradigm shift that calls for a strictly defensive investment framework. There are two critical transmission mechanisms currently at play. First, cognitive misalignment. Decision makers are applying commercial logic to existential conflicts, leading to systematic failure. Second, algorithmic resonance. In our 2026 ecosystem, natural language processing algorithms amplify risk. A single semantic deviation in a policy text can trigger a global liquidity crisis in milliseconds. Given these risks, we must lean on what I call the 4 pillars of survival. First, accept the fragility of policy output. Second, refuse to engage in immediate gambling during vertical market moves. Third, fund your advantage by extending your decision horizon beyond the reach of the machines. And fourth, utilize radical asset class dispersion to hedge against policy misdiagnosis. Turning our attention to the global scoreboard, the current environment is clearly one of no safe harbor. Looking at the weekly breakdown, in equities, we see a stark divergence. While the Nikkei 225 gained 2.1%, the energy-sensitive German DAX fell 2.3%. In commodities, crude oil surged 12% on blockade fears, while gold fell 3.1%. This brings up a critical point, the gold misalignment. Gold is currently suppressed by the logic that war-driven inflation will postpone Fed rate cuts. A true period of appreciation will only begin when inflation expectations cool. Meanwhile, in the AI shelter, semiconductors show a fragile independence due to mandatory capital expenditure from AI giants. We advise caution against blind optimism regarding its sustainability. Shifting our focus to the world's 2 largest economies, in the United States we are sinking into a stagflation mire. Consumer confidence has collapsed to 49.8, the lowest recorded since 1952. Simultaneously, a brutal structural purge is underway in the labor market, with Meta and Microsoft announcing significant layoffs as capital shifts toward AR. Across the Pacific and China, the Shanghai Composite 3-week rally is losing momentum. While semiconductors remain a highlight, they risk exhaustion. We recommend trimming positions in growth-dependent sectors like tourism, real estate, and discretionary consumption. Looking ahead, the mid-May US-China summit represents the final defense for a global soft landing. However, systemic cracks are widening. The fragility of private credit redemption chains at firms like BlackRock remains unpried. Furthermore, the Western alliance is showing deep fractures, with Canadian leadership warning that a close relationship with the US has transitioned from an asset to a liability. In this environment, even holding cash is no longer a path to safety due to high inflation in the making. Lies in the reshaping of investment behavior. Thank you for joining Bill's Market Insights. Stay disciplined, and I'll see you in the next briefing.